Bismillahirrahmanirrahim. What is up, guys? My name is Hassan and welcome back, everyone. Today we're going to give you guys a stock analysis video on a brand new company, a high growth company known as Tattoo Chef, ticker symbol TTCF. I think that this company has the potential to double in the next 1 or 2 years. You can see Tattoo Chef right here. Currently it is at $24.09. If we scroll down, we can see their revenue growth year after year. We can see that in 2019 we can see here in 2019 they were at $16 million. And if you look at the trend, overall trend of the revenue is increasing pretty much quarter after quarter or year after year. And we can see by the time we hit Q1 of 2021, we should hit almost $44 million in revenue, which I like the consistent predictable growth year after year or quarter over quarter. They are having record-breaking sales and revenue, which we can see it based on this chart right here. As always, before I begin, don't forget to check out the disclaimer in the description below and my Islamic perspective. And if you guys stick around for a few minutes, I have a gift for you guys. It is going to get you guys really excited. You can actually use it and buy things from Amazon, Target, CVS, and in a way you will be able to get something that is tangible. So stick around for a few more minutes and I will show you guys what gift that I'm offering you guys. It is a potential to earn other things. You guys can see that this is my Robinhood portfolio. It's currently at $30,000 and this is the highest I ever reached. For me, $30,000 is a lot of money. And if I show you guys for one day, I'm down about $100. And then if we take a look at it for 1 week, I'm up around 3.3%, which is equivalent to $985. And then if we look at it for 1 month, I'm up around 4% or almost $1,200 or a little over $1,200. And then if we look at it for our 3-month chart, 12.8%, almost 13%, which is equivalent to $3,400. And then if we look at it for the 1-year chart, you can see a nice consistent overall increasing month after month. And for the year, I'm up around 31%, which is equivalent to $7,200. And this is a lot of money for me. This is money that I did not have to work for. It's money that was given to me because this is passive income. Investing is passive, where you have your money work for you. Another thing that I want to point out, yes, I made 31%, but that's excluding the dividend. So dividend is actually around almost another 3%. So if you add the dividend to this, I'm actually around 34, 35%. Another thing that I want to point out, I really don't like to look at the 1-month chart or the 3-month chart because it doesn't really show us the true picture. I care more about the direction that my companies are going, my investment portfolio is going. I like to look at the overall long-term trend of my portfolio. And on the right, you guys can see here some of my holdings such as AMD, KL, Texas Instrument, Nvidia, Johnson & Johnson, Caleres, and 3M. If you guys check out some of my other videos, you guys will actually be able to see rest of my holdings, and also I'll show you guys my all-time gains. But for that, you have to check out some of the other videos that I have, because today is a stock analysis video on Tattoo Chef. So I'm going to take you guys back to Seeking Alpha, and you guys can see here Tattoo Chef currently at $24.09 TTCF. Tattoo Chef is a plant-based food company that produces and sells frozen food products. It supplies plant-based products to retailers in the United States. The company offers products such as ready-to-cook bowls, rice cauliflower, smoothie bowls, more cauliflower, and pizza, and so on. So these are frozen food that you get at ShopRite or Costco and so on. And these are plant-based products, which is a big trend right now. Everybody wants to eat healthy. Another thing that I want to point out here, I want to actually show you guys how much I'm invested in this company. If we scroll down some of my holdings, you can see here Tattoo Chef. And if we scroll down, you can see that I'm currently 29.2 shares or 29 shares, and it's equivalent to about 2.3% of my total portfolio at an average price of $23, which is equivalent to around $700. So you can see here that when I do a stock analysis video, for the most part, I try to own it because I'm not a person who only talk about investing. I actually do it. So, and you guys can see there, I do have some skin in the game. I have about $700 of investment into Ttcf, which is equivalent to 29 shares. We're going to look at their financials. Before I show you guys their financials, remember I said that I have a little small gift for you guys if you guys stick around for a few more minutes. The reward or the gift that I have for you guys is a link to my Fetch app. Which is Fetch Rewards. It lets you earn points every time you scan a receipt. So remember how we always get a receipt from Dunkin' Donuts or Amazon or Walmart and we throw it out? But now you guys are going to be super excited because every time you get a receipt, you're going to download this app through Apple Store or Google Play, and then you can just scan it and you get points. And once you get those points, you can redeem it for gift cards like such as Amazon, Best Buy, Target, Apple Store, and so on. And this is amazing app, guys. Check it out. Use the link in the description below, and that way you get 2,000 points. I get 2,000 points, and it's legit because I used it. And I already got at least $10, $15 worth of rewards from Amazon, and I'm hoping to get more. So, guys, check out this app. Make sure you guys use the link in the description to get the rewards. It's an amazing app. I wouldn't recommend it if it wasn't this good. So now we're back. So if we take a look at Ttcf, if we look at their revenue, for the revenue in 2018, they were at around $47 million. 2019, they were at $84 million. And then for 2020, they're at around $135 million. We can see a nice consistent growth, and that's what we want to see. When I do a stock analysis video, I like to see their revenues growing. After I see that their revenue is growing massively, nice consistent pattern, next thing I like to look at is their gross profit. Not only is their revenue increasing, their gross profits are also increasing year after year. We can see that profit of 2018 is around 3.2, and then if we scroll for 2019 is 13.7, and then if we look at it for last year 2020 or the last 12 months, we can see that it is around $20.6 million or almost $21 million in gross profit. So their revenue is increasing, their gross profit is increasing. So far, things are looking good. As a Muslim investor, we also have to look at their interest expense, which is very, very important to us. So if we go down here, we can see here their interest expense, and they do have some interest expense. And that's problematic because we want to invest in companies that have zero in interest expense. And hopefully in the future that they get rid of this interest expense. I want to take you guys to do a quick check on Sharia compliance. And remember, there are various methods to do it. This is one of the methods that I like to follow to show if it's Sharia compliance or not. And one of them that, first of all, the business has to be halal, meaning the word here halal means permissible. Like, for example, Ttcf, it's a plant-based product. I don't seem to think that there's any problem with it. So we can check that off. The business seems halal. Then we have to check the interest expense. So we're going to go back to Ttcf. We're checking the interest, and we can see that it's around 0.6 million. And we're going to calculate it over the gross profit. So we're going to pull out our calculator. We're going to do 0.6 divided by 20.6. And this gives us about 0. And we're going to times it by 100 to get it in percent form. Currently, their interest expense is around 2.9%. And in order to be a Sharia compliance, it has to be less than 5%. So far, it seems good. And plus, this is just a good business model. Like a company should not, if they're paying a lot of interest, that shows that the company is not well managed. They're not managing their debt well enough or efficiently enough. So this shows that their interest expense is 2.9% of their gross profit. I like the number as low as possible, even less than 1 or even 1% of their gross profit. All right, the next thing I like to look at for Sharia compliance is that business is halal, the interest expense is less than 5%, and these are just good business practice. Like in looking at and analyzing a company, we should just do this for all the companies just to see how well they are managed. The next thing we want to look at the haram revenues. Haram here means impermissible. Halal means permissible. Haram means impermissible, including interest income should not exceed more than 5% of their total revenue. Another thing that they're pointing out here is that if a company does pay a dividend, and you see that they have some kind of interest income, we should always donate some portions of our wealth in charity to purify it. Now we're going to check out their interest income, and it should not exceed 5% of their total revenue. So I'm going to take you guys to their 10Q for the latest 2020, and we can see that their interest income here is around $804,000. So now we're going to compare that with our revenue. So we have our interest income here is 804,000, and we're going to divide it by our revenue of 135 million. So we see 804,000 divided by 135 million, and we get a number. We're going to multiply this by 100 to get it in percent form, and we get that their interest income is less than 1%, which is another check in Sharia compliance. So their interest expense is less than 5% of their growth. Their interest income is less than 1% of their total revenue, which is showing us that this is a very well-run company. In theory, in reality, we actually want companies that doesn't pay any interest or receive any interest. So guys, if you guys made it this far, hopefully you guys hit the subscribe button, hit the like button. It helps us grow the channel. It helps us reach out to more people and help out more people. Remember, in the investing game, we're all on the same team. We're not playing against each other. Instead, we're on the same team trying to win against the market and do well to reach a financial freedom. Continue with our analysis. We see their revenues increasing, their gross profit is increasing. They don't have a lot of debt, or at least interest-bearing debt, collecting a lot of income. And the next thing we want to do is we want to look at their long-term debt. And we can see here that their long-term debt is actually decreasing. So we had 3.3, now 2019 they're at 3.1, and then if we scroll for the last 12 months they're at 2.3. So overall, this is a healthy sign. Their long-term debt is decreasing. How well the company is being managed, how well the company is being run, because not a lot of people talk about this, because management plays a very big role in, and it just shows that it's being run very well. So next thing I want to do is look at their current ratio. So current ratio is a company's short-term financial obligations that are due within the next 12 months or within the next 1 year. What are current liabilities? These current liabilities include accounts payable, expenses, short-term debt, dividend, notes payable, as well as income tax owed. These are obligations that the company has to make in the near term. Within 1 year, they have to make or meet all these current liability. And it's really important for us to check that. Is the company able to sustain itself? Can the company continue to pay for all their expenses? So current ratio formula is current asset divided by current liability. And we're going to go back to our Seeking Alpha. Current asset is around 52.6. So again, we're going to pull out our calculator, is 52.6 divided by, and we're going to look at our current liabilities. Scroll down. Current liability for the last 12 months is around 56.6 divided by 56.6, and we can see that the current ratio using this formula is at 0.92, which is a little problematic because we want to look for companies that has a current ratio of 1 and above. And this is almost at 1.92. If we round it, we can reach 1. We can see that the company is running, the company is making revenues. Any near-term problems arising. 0.92, yes, we want it to be 1 or higher. If you made it this far, hopefully you guys hit the like button, hit the subscribe button, and it helps the channel grow. And check out some of my other stock analysis videos that I have done in the past, and all those companies are up massively. So I just want to quickly take you guys to their Analyst Day, December 2020. Take a look at their history. We can see that they were started around 2009, around here. They only had 2.1 million in sales. They used to be called Stonegate Foods. Now they're called Ttcf. What I want to point out is their 5-year growth rate. So CAGR means that compounding annual growth rate, which is 63%. So in the 5 years, they have been growing almost 63% annually, and which is a very, very high growth company. And this is one of the reasons why I like this company so much. Another thing that I want to point out, or some of the highlights from this company, is that they were able to grow their brand, they were able to grow their revenue with $0 in marketing. So pretty much they paid $0 in advertising. So without advertising, they're growing like crazy. And this is a very, very strong, healthy sign. And I think once they start investing money into advertising, they will have a lot more growth in the company. As always, guys, I think that this is a great company. It's very well managed. It has a high growth, and I see them doing really well. As always, guys, if you made it this far, please hit the like button, hit the subscribe button. As always, thank you. See you guys next time. Bye, everyone.